Us right now, Richard Harris, the Chief Executive at Port Shelter Investment Management, joining us on the show right now. Richard, great to have you on the show. Thank you so much for joining in. Just wanted your perspective on India as opposed to the rest of the world, because you see all these positive headlines come out of the US economy. The market is well rip-roaring, and it's quite the contrast when it comes to the state of the Indian economy right now. What is your take on how India would fare as a market in the near term?
Well, I think one of the issues about India, of course, is that it's actually done very well over years previously. So it's not unusual to see a market come off, maybe underperform against some of its peers in that respect. But I don't think India has done that badly. It's just not done in 2019 as well as other markets. Don't forget, other markets also did badly. China did very badly in 2018, done extremely well in 2019. So we're seeing a little bit of a catch-up, I think, of other markets. My concern, though, about, and I'm just looking at some stocks in Hong Kong as well, and with the same idea in mind, is that 2020 could easily be quite a different market globally. We've seen some fantastic moves this year, Wall Street up 18-20%, something like that. These are really exceptional moves. And it probably doesn't take a great analyst to suspect that, what comes up might actually go up not quite as well next year, especially when you're looking at those levels. So 2020 could be more difficult. If it is, then I would see that putting a burden on other markets and local factors as well.
Okay, fair enough. Richard, it's a big week. We're watching out to see if there's any resolution on with regards to the trade talks. Looking unlikely as of now that they'll meet the deadline of the 15th. Do you feel markets have priced that in, or do you anticipate further volatility?
I think markets have probably priced in not much happening. We've had several deferrals of these new tariffs coming in, the ones that are coming in on the 15th of December. So I think the odds must be, and the market's probably taking the view that this one will be deferred as well. I also think that nobody really expects that there will be a deal done by the end of the year. So we're probably in a situation where the market kind of feels it's going to be business as usual, at least for the next 3 weeks or so. However, there could be a surprise. If a deal's done, the market will have a good period till year end, and that could be very good because of the lower liquidity this time of year. We could see that impact come on the market. If Trump does put tariffs on an extra 150 billion of trade with China, then we could see the opposite. So I think we may be looking at a fairly volatile period towards the end of the year if news changes. But I think the market is currently looking at basically business as usual, deferral of those 15th December tariffs, and just carrying on as we were.
Okay, fair enough. Do you feel perhaps, Richard, one of the factors that could perhaps destabilize things is what's happening in China, given the pressure that they're already seeing, the debt ballooning, latest data being fairly weak? Or do you feel perhaps some of the other emerging markets like India are just going to benefit on the back of that?
Well, I'm not sure India will necessarily benefit, if China does badly. There are different factors involved. China does have a series of quite difficult economic situations to deal with. We had a report last week showing quite how much extra debt has been put on the economy since, over the last 2 years. Certainly over the last 10 years. That is a big issue. We're seeing an increase in defaults. That is a big issue. We're seeing the trade situation with China bearing down on manufacturing in China. That is an issue. In a way, these are specific issues that are specific to China, not necessarily to India. Once again, I think that we're going to see an overriding impact of what's happening in the global economy in 2020 that will put pressure on both China and India and other emerging markets. And that's the thing we're going to have to look out for, is what's happening in the world, not necessarily what's happening locally.
Richard, morning. Let's also get in your take as to how you're looking at, the overall strength that we've been seeing and movement as well that we've been seeing in the currency, the US dollar. What's the sense that you're getting as to how that's likely to, just give us a general sense as to how you believe that this could likely impact some of the other emerging market currencies and, any future course of action that you're expecting for the greenback?
Well, I think what's really been happening in the US this year is that consumer confidence has remained fairly bullish, but we've also had quite a big increase in money. We've had the Fed putting liquidity into the market. We've had the Fed cutting interest rates. We've had full employment. In fact, I think unemployment is now down to 50-year lows in the US. So things are humming quite well. We've got a president who's very much an introspective president, so looking internally at the country and at the market. And America is still a big enough economy to really furrow its own course, while Europe is sluggish, while maybe emerging markets quite be sluggish. But again, I think the fact that we do have quite a lot of liquidity around and debt in other markets, that's likely in the short term to be supportive, but in the long term to be a concern, because it does mean an increase in asset prices because of an increase in debt. So I think that's a concern looking further out. But in the very short term, this liquidity bubble might keep things humming for a while, possibly into the first quarter of 2020.
Right, Richard. Thank you for taking time out and joining in, sharing with us your view on the global markets as well as what the impact is on the emerging markets, particularly India.